Hi everyone, this is Kathy Lien with BK Forex. Before we begin, I'd like to make sure you can hear my voice again. So please just say yes if you can, and then we'll get started right away. All right, fabulous. All right, so what I'm going to do is I've closed my Q&A box because it can be slightly distracting, but feel free to post your questions along the way. And once I finish with my presentation, I will go back to the questions and answer all of them. So, feel free, once again, feel free to post questions as we go. So let's get started. My name is Kathy Lien, and I'm managing partner of BK Forex. I'm delighted to be spending an hour with you, 45 minutes with you today, talking about how to trade in a low volatility environment. Now, you may all know that trading ranges in currencies have been narrowing, and this narrowing in trading ranges is creating a situation where we're seeing much more in the way of fake outs than we are breakouts. And it's important to be able to understand why this is happening and what you can do about it, because it's been very frustrating to a lot of traders and investors for that matter. And when the markets change, we have to as well. Before I continue, I'd like to remind all of you that trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, I'm pretty sure FX Street is recording this. Please make sure that you read through this disclaimer, make sure that you're aware of the risk before moving forward, and read through our disclaimer at the bottom of the screen as thoroughly as possible. Okay, so let's take a look at some of the recent trends in FX volatility. What I'm going to start with is I'm going to start with showing you my charts, and we're just going to look at the daily charts. And you can see that even with some major event risk, and I think it's probably best to look at a weekly chart, like the ECB deciding to ease monetary policy, Federal Reserve beginning the process of tapering, we've been stuck in a pretty consolidated range in most of the major currency pairs since, I would say, September, October of last year. You can see that euro has been fluctuating between 133 and 140, with most of the price action contained between 135 and 138 for pretty much, I would say, the past 9 months. Taking a look at dollar yen, the same is pretty much true if you ignore the big, barring the big jump in dollar yen towards the end of last year. The range for the currency pair has pretty much been 175 up to 105, with most of the time spent between 175 and 103, which is an extremely narrow range for a major currency pair over such a long period of time. Even pound dollar, which tends to be a little bit more volatile, and it is, and it has seen a bit more of a trend-based move, it too has been consolidating for a shorter period. It's been consolidating pretty much since, I would say, April this year. But in general, the 165, 170 range for most of the past 4 or 5 months is relatively narrow. So you can see, unlike late 2013, where we had a very nice trend move in the pound dollar, we're not seeing as much extension in the currency. All right, I'm getting comments the charts are changing slowly, so I am going to talk a little bit slower. So now we're looking at the weekly chart of the Aussie dollar. 90.95, most of the year we spent between this range, and for the past 3 months or so, we've been, that range is narrowed to 92.50 to about 94.50. So the bottom line is the big moves that we saw in 2013, first of all, are not continuing into 2014. And you don't see it in just the price charts. You see it in many other places as well. I mean, for example, if we look at option volatilities, and I know your charts are changing very slowly, so I will pull up the chart first and then talk about it. So first of all, I want you to notice that all of the 1-month volatilities in the major currency pairs are pretty much, with the exception of Kiwi dollar, below 6. They're they're below 6. And with pound dollar volatility at 4.6, which you'll see in a second when we look at the chart, these are exceedingly low levels. And in some cases, we haven't been at these levels for a very long time. Taking a look at the euro dollar 1-month volatility, I'm pulling up a chart right now, and I'm going to expand it to a max chart. Just give it 1 minute to load up on your screen. What you will notice from this max chart is that we have not been at volatility levels this low since 2007. And in 2007, this was, quote unquote, the lowest level in volatility that we have seen, since 99. So this puts it into perspective how, not only is volatility, extremely low levels, but it is definitely below its long-term average. The long-term average since the launch of the euro, the long-term 1-month average for the euro dollar volatility is 10.3%. And right now, volatility is at only 5%. So we're about half that level. Let's see if we can go back in our screen. Well, let's see if we can change this right here. Okay, so now I've changed this to 1-month dollar-yen volatility. Once again, we actually have exceeded. I'm not looking at it. Let's try to get a max chart here. We're looking at a max chart, which is all the data that I have on Bloomberg, and you can see the dollar-yen volatility right now is at the lowest level ever, during this entire period. So what this tells you is that we haven't seen such consolidation, significant consolidation in dollar-yen pretty much in the past, I would say, almost 2 decades here. And historically, the long-term average is about 11%, and right now we're only at 5%. The only other one that we're going to look at here is pound dollar, and then we'll move on to take a look at something else. So pound dollar, its average volatility is lower in general. Its average volatility is about 8.82%, and so right now it's 4.6%. So pretty much it's averaging half the amount it was before, which is consistent with what we've seen in the other major currency pairs. But still, in 2007, vols went down to 4.7. We're below that right now, and we're also below the level since 96, so the lowest level. So basically, what this tells us is that sterling or pound dollar volatility is at its lowest levels in 18 years at minimal. We're not just seeing this volatility, this contraction of volatility in currencies. We're also seeing it in equities. You may know that about the VIX, which is the measure of volatility in the U.S. stock market. And let me just pull the chart up. Okay, so I'm pulling up a chart of the VIX, and volatility in U.S. equities are pretty much at their lowest level since, let's see what this low is here. Pretty much this lowest level also since 1990. So putting this into context, we are seeing an extremely significant decline in volatility across the financial markets. It's not just in currencies, but it is also seen in equities. JP Morgan put together this really interesting table here, talking about periods of low volatility and how long they have lasted. So if we go back to the euro dollar, one second. If we go back to the euro dollar, we can see that we were pretty much at 7% not too long ago. And overall, the low vol environment didn't really, come into fruition, I would say, until April this year. So we've only been in this real low vol environment for 2 months. So the question that you may ask is, how long can this low volatility environment last for? And let me see if I can zoom into this a little bit more. And all that I think is really important to pay attention to is these averages here. Since 1970s, the average period of time that a currency pair has been in a low vol environment, which is basically below 7%, which below 7% is considered low volatility, is 223 days. Since the 1980s, it's been 153 days. So right now, we've been in a low volatility environment for only approximately 60 days. So this suggests to us that there could be more pain for those of you that are that trade breakouts and are looking for breakouts, because what this historically tells us is that we may just simply be at the very beginning of a slowdown, of a decrease in volatility, for example. So this leads to the question about, why is this happening? Why are we in an environment where volatility has declined so much when we are getting, things like the ECB implementing unprecedented measures in terms of monetary policy? Well, first we have to understand, in the general context, there's been a lot of crowded consensus trades. There have been a lot of people who have gotten into, selling euros in anticipation of ECB easing, buying US dollars against Japanese yen in anticipation of, tapering by the Fed and BOJ easing, as well as selling US treasuries. So there were a lot of trades that got very crowded, and when we didn't get the data, or we didn't get the movement to validate those trades, they did not continue. There was also a lack of, uncertainty in monetary policy. There's been, we know what the Federal Reserve is doing. The ECB, even though they eased, they probably are not going to make any additional changes for a couple of months because they want to see how the economy responds to the latest bouts of easing. There's absolutely no urgency within the Federal Reserve to tighten monetary policy. So they're going to be very comfortable with the way things are going right now. They're going to continue to taper asset purchases, probably end QE this year, but they're not going to see any sort of great motivation to tighten. Low yields, we're in an extremely low yield environment. So when we're in low yield environment, that decreases return, and it also decreases the motivation by a lot of investors and traders to get into new trades. And then finally, a lot of major macro funds and as well as investors have been floating these big losses as a result of these crowded consensus trades. And we are floating big losses, still thinking that these things are going to move in your favor. You may not feel all that urgency or encouraged to take on additional risk. So these are just some of the reasons why low volatility environment is happening. So, eventually volatility has to revert back to the norm, back to the average. But, what can trigger that? Well, it would obviously require something, significant, like the Fed basically, deciding that it wants to begin tightening sooner than the market anticipated, some sort of major geopolitical risk, and that's pretty much it. Because right now we expect, it's overwhelming belief the Fed's going to pause for a very extended period of time once quantitative easing comes to an end. And when they do so, that's probably going to be bearish for volatility. So that would be consistent with, the stats that JP Morgan published, which is that we could have anywhere, I think, take a look at that, back at the stats, the average period that we've been in a low volatility environment is about 153 days, to 223 days if you go back to the 1970s. So right now we're only in 60 days. So we could be looking forward to another, 3 or 4 months of low volatility. And this shows you in the past, since the 70s, what was the trigger for a reversion back to the mean, meaning what was the trigger for an explosion in volatility and for, basically exiting this low volatility environment. And you can see this crazy stuff like Sterling crisis, Black Monday, German reunification, Soviet Union collapsing, Asia crisis, Mexico crisis. Obviously, we hope that doesn't happen again. There's other things like Fed hikes, U.S. recession, U.S. slowdown, and in this case, it will most likely, at least I hope, that it's going to be a resumption of, or initiation of Fed tightening, and not one of these crazy geopolitical or macroeconomic risks that could occur. Because a lot of times, those macroeconomic risks occurred when people got overly excited and they took on too much risk, leading to a crisis. And I think that in this current market environment, people are much more cautious and less apt to, jump on board with basically, taking on significant risk without knowing what's going on. All right, so it's important in a low volatility environment to adapt to trading because it can last for, at least another 3, 4, 5 months, perhaps longer, if the Federal Reserve maintains steady monetary policy and does not, move in any way, shape, or form. So how do you adapt your trading to a low volatility environment? There are 4 ways you can do so that I can suggest to you. One is trade short term, because a lot of the movements that we are, any sort of explosion or increase in vol that we have seen has happened on a very short term basis. So you can focus on trading short term. You could focus, this is the type of environment where you want to buy low, sell high, where, trading ranges probably works. And, until I think the Fed decides to, taper, that, trading range is probably the way to go. Trade event risk, short-term increases in volatility will be created by event risk. And so if you are a momentum trader, then trading event risk is probably a better way to go. And it's extremely, extremely important to manage your profits. So I want to talk about some of these in further detail. And I want to talk about it by first talking about who are the most profitable traders in the world. Now, you may or may not know that Oanda publishes, Oanda, one of the largest brokers in the world, publishes daily statistics on their most profitable traders. And what I want you to notice is that these traders hold their trades. I want to get rid of this thing. Okay, these traders hold their trades between 1.8 hours to about 5 hours. And the average realized PIP that they seek to earn on these trades is between 5.8 pips and 12 pips. So what does that tell us? That tells us that traders at Oanda, which is probably a good representation of traders around the world, their most successful traders trade short term. But their definition of short term basically represents positions that are held for hours and not minutes. In many ways, this is very similar to the way we trade at BK. Our Ajax strategy, which is our favorite strategy that we've been trading for the past couple of months, trades extremely short term with positions held for hours and not minutes, and aims for up to 20 pips in profit. Now, I want to take this idea a bit further. Think about traders who are seeking to earn, who end up earning 6 to 12 pips with positions that are held for hours. They must be using negative risk reward, right? Because otherwise, at 2 to 1 risk reward, their stop would be 3 to 6 pips. And at 1 to 1 risk reward, their stops would be 6 to 12 pips. And given the volatility of some of these pairs, like pounds yen, for example, or euro yen, for example, they will end up being stopped out at a blink of an eye. So under these circumstances, it is almost impossible to hold a position with such a tight stop for hours. So in a nutshell, what are these guys doing? Well, what I believe they're doing is that they're trading short-term with negative risk reward. Now, although this may seem counterintuitive, trading short-term with negative risk reward is a tactic that is also used by many successful bank and prop traders, and actually one that we follow ourselves. In order to understand why many traders use this technique, we have to first appreciate why they trade this way. Traders in banks and prop shops do not normally take on significant risk. They have strict risk control parameters imposed by the employers and always have to be cognizant of making sure that they do not exceed those restrictions, because they know that when that happens, they will be called into the offices of their risk department and asked to justify all of the reasons why they have taken on so much exposure. So in order to avoid being in this uncomfortable scenario, they will generally trade short-term, getting in and out of positions quickly. In a low volatility environment like the one we have today, this becomes even more important. According to a presentation that I found on the ECB's website, and they actually posted a presentation by CityFX, I found this interesting quotes that said that Japanese brokers, who, you may know that, traders in Hong Kong and Japan tend to be the most successful, hold their trades generally for an average of 2 to 3 hours. The other stuff is interesting, but, in a different context, but they hold their positions for an average of 2 to 3 hours, which really, if you think about it, is not that long at all. So while we may want to trade short term, and some of us may do so very successfully, perhaps it may be prudent to understand that right now it seems like, in this type of market environment where, the type of people who are succeeding are the ones that are holding their positions for that sweet spot, which may be only a couple of hours. Now, when you are learning about trading for the very first time, regardless of whether you're trading forex, equities, or commodities, you're almost always taught to abide by the Holy Grail of 2 to 1 risk reward rule. The reason why this rule is so popular is because you don't need to call the market right very often to win, and you don't need to be very accurate, because with the negative risk reward ratio, you need to be very, very accurate. In some cases, you need to be as much as 70% accurate or better to make substantial P&L. But adhering to a 2 to 1 risk reward rule, in my opinion, is also a big reason why many traders lose money, especially in this low volatility environment, where you need to be really, nimble and quick, because you're not seeing the big extension moves that you have been seeing in the past, even in 2013. The currency pair just goes a little bit more in your direction, and so you need to make sure that when it goes in your direction, it may not go to 50, 60, 70 pips that you're hoping for. It may only go for 20 or 30 pips. So therefore, you need to be very, very diligent and make sure that you grab those profits quickly when you get them. Take a look at this chart. What this shows you is the average daily trading range for the euro dollar. As you can see that the average range for the euro dollar is slightly more than 100 pips. In the pound dollar, it's also slightly more than 100 pips. And in the Aussie dollar, the average daily range is only about 60 pips. So what does this mean? This means that if you're looking to make 60 pips on a euro dollar or pound dollar trade, which is about 60% of the average daily range, your stop needs to be 30 pips on 2 to 1 risk reward. And unfortunately, both of these currencies can move up or down by 30 pips at a blink of an eye for no specific reason. So I think that the key to one of the most important aspects of trading in this low volatility environment is to use what may seem counterintuitive, but has worked very well for us, which is negative risk reward. Because if you imagine, if you risk 1 to 1, you only need to be 51% accurate to be profitable. If you risk 1.5 to 1, you need to be 61% accurate to be profitable. And if you risk 2 to 1, yes, you need to be win 67% of the time to be profitable. Now you may ask, can these numbers be achieved? And my answer is yes. In fact, the strategy that I'm going to share with you today, or give you some insight into today, which is called the Ajax Indicator, aims to maintain an 80% accuracy rate. This is how the indicator has traded NFPs over the past 2 years. And in this scenario, we have 27 trades. And out of those 27 trades, only 2 have been losers. So let me show you what the Ajax rules are, and then we'll just get back to some examples. So the Ajax rules, and we're just going to look at some examples, an example for NFP and an example for ECB. And I'm going to show you rules, just short rules, because the long rules are just completely opposite. All right, so we've got a lot of flavors of trading the Ajax, but for those of you that are learning it for the very first time, these are the most basic rules, the most basic way, vanilla way of trading our Ajax. The Ajax trading strategy is a event risk strategy, but one of the great things about the Ajax strategy, and actually all of our event risk trading strategies for that matter, is that we don't trade immediately after the data. We always wait. We always wait for volatility to settle a little bit before getting into those trades. So with the Ajax trade in particular, what we do is, first of all, we wait for 3 5-minute candles to occur. So we wait for 15 minutes after the release. In those 15 minutes, if any of those 5-minute candles closes below 20, which means it's deeply oversold, there's no trade. Because the probability is high that most of the price adjustment is made. But if the 5-minute candle closes with an RSI reading of between 20 and 30, then what you want to look for is RSI in the 5-minute charts to rise above 36 on a closing basis, and then drop below 36 on a closing basis. So this is what constitutes a retrace in price and a reestablishment of the downtrend. At that point, you want to go short at the start of the new 5-minute bar with a 20 pip stop on our majors and 10 pip take profit. So let me show you how this could have been traded at the last non-farm payrolls report. So we actually traded this, dollar yen really had no opportunity. It's a 5-minute candle in the last non-farm payrolls report because we really didn't have any type of volatility in the currency pair. Because we actually moved below the RSI, if you take a look down here, actually moved below 30, pretty much right before the news candle. And so between the news candle and the next 15 minutes, we really didn't have, any movement whatsoever. And pretty much for the whole day, we didn't have any movement ever into overbought or oversold territory for the RSI. So there was no opportunity in the pound and dollar yen. But, dollar yen is not the only currency pair that we trade Ajax on of these events. So there was a setup in the pound dollar. Go back to June 6th. So this is what we're looking for. So at 8:30, you can see pound dollar shoots higher, and then the RSI goes above 70 in this case. It dips below. So in this case, what we're looking for is we're hoping to see RSI rise back above 70 and renew its uptrend. But that does not happen. It doesn't rise back above 70, and pound dollar starts to fall. And this is one of the great things about Ajax because it's directionally agnostic and data agnostic. Even though it seems like the data was dollar negative initially and pound dollar rallied because it never broke above its previous high and the RSI never went back above 70, then there was no trade. So instead, where there was a trade, because we keep our orders on our books for 4 hours, there was a trade right around this time over here, around 9:25, where my crosshair is when RSI dropped below 36. So it dropped below 36, and then it went back above 36 shortly thereafter, and we basically end up going short the pound dollar right around here at 167.90. When short 167.90, I think when we sent our Ajax trades to our subscribers, the exact price was 167.95, and then we took profit at 167.85, which was somewhere around here. With the ECB, we also did not have any clear setup in the euro. So the trade that we had was in euro yen. So we're going to go to June 5th, which is when we had euro yen. And with the ECB, we didn't trade the initial ECB announcements. And but if we did, that would have still worked out, because if we traded the ECB initial announcement at 7:45, we see the Ajax indicator dip below, but actually the problem is that went all the way to 20, so there's no trade this time. The actual trade itself happened after Mario Draghi started to talk, and usually we put on our ECB trades at 9:15, or we put on we start to look for our setups at 9:15. So nothing really happens. We watch euro yen rally, and we see that the RSI goes above 70, but just because it goes to 70 doesn't mean that it takes time to the trade. Then we see that the RSI, kind of dips a little bit, and this is where it goes back above. So it goes above 70, goes back below 70, goes back above 70 within our 4-hour time frame. We go long euro yen, and in case of euro yen, because it's a cross, we're going to look for a 20 pip profit. So we go long at around 139.70 or so. And then our profit is at 139.90, so we take profit somewhere around here in our post-ECB Ajax trade. So you can see, while we trade news, we trade big news, it's relatively relaxed in the sense that we may get into the trade, an hour, 2 hours, 3 hours after the event risk, and we may end up, in this case, we hold it for about an hour or so. Sometimes we end up holding it for longer. And so that's basically 2 examples of our Ajax strategy. So I said that, in order to adapt your trading to a low volatility environment, one idea is to trade with negative risk reward and be very nimble with your profits. Another idea is to trade short term. The Ajax indicator kind of shows you how to do that. And then finally, it's really important to manage your profits and not your losses, because we never know how much we're going to get out of the markets. Because stop losses are inevitable, especially in low volatility environments where retrace risk is high, and should be used always to prevent catastrophic losses. But many trades are often partially profitable, and the key to long-term success is to never let a winner turn into a loser. And so, here are 3 ways to help manage, get you into the mindset of help manage winners. One way, number 1, is to have a short exit, long exit. We do this for our BK swing trades, where we exit half our position at a relatively closer amount, usually half risk, and then we trail our stop, hoping to get more, because with our BK swing trades, these are medium-term trades that we are going for a long-term trend, so we use a short exit, long exit. The other method is to, when price moves X% of the money, move your stop X% to lock in the profit. So we do this with our Ajax trade. I show you the basic flavor of Ajax trade, but you will notice that sometimes, when I show you the NFP results, the P&L was 0. And the reason why the P&L was 0 was because sometimes we'll move our stop to break even as it moves in our favor. And then we'll continue to move it, a couple of pips upwards, as it continues to move, to make sure that a winner does not become a loser. And finally, dynamic trailing stops. Dynamic trailing stops provide the best of both worlds by letting you your profits run while protecting your trade. And this is another example of a dynamic trailing stop where you can trail your stop. These are good for medium-term trades. You can also use it for short-term trades. Trail your stop, basically as it moves in your favor. So with that, with that, I'd like to take a look at any questions that you may have. If you want to learn more about the Ajax strategy, you can go to this link here where we aren't providing strategy at this time, but once we release it again, we'll send you an email on that. But it's basically you can click on this link and let me see if I can put it into the chat box. And you can sign up for our mailing list when we do provide more information on the Ajax strategy. All right, so now questions. I don't see any questions posted while I was chatting, so perhaps you understood everything I said, but please let me know if you have any questions. Okay, so there's a question, so please, if you have questions, please post them. Is a strategy time specific? Basically we start to look for setups 15 minutes after the data and up to 4 hours. Brokers win 100% with these short-term trades. I don't know if that's a question. I mean, we've got a strategy that, where we win, a good amount of time. So I don't think that, I think that it shows brokers don't always win. Any other questions? What's my expectation for Aussie dollar this week? I think that Aussie is probably going to head higher. We may have some good data, and China and Australia has definitely got higher highs, higher lows. I think it's headed, to 94.25. I spent a lot of time talking about why we're in a low volatility environment. So when this recording goes up, feel free to go through it, because the whole first half of the presentation was about why we are in a low volatility environment. Is the Ajax strategy time specific? I answered that already. I said yes. 15 minutes after the data is when we start looking for setup, up to 4 hours. And if you want the link, this is just an informational link. We no longer offer the Ajax indicator, but if you want to get updates on it, when we do, just put your information in there, and we will. Oh, sorry, I didn't send it to all attendees, and we will make sure you get it when we get the information out. Any additional questions? The reason why the strategy is called Ajax is because Ajax is a poker term that basically pertains to aces and jacks, which is the best starting hand you can have in poker. And so the strategy tries to put the odds on your side by creating a scenario where you're starting with the best starting hand. Is it a strategy used only during events? Yes, it is used only during events, but it doesn't have to be just the big events like NFPs. Like we're trading it this week on Australian business confidence, UK industrial production. We are there are big events like RBNZ, but it's not just big events. So you spoke earlier that the volatility is significantly higher after surprising news like a big market crash. Do you think the problems with Ukraine may cause such volatility? I don't think so. I think the problems with Ukraine, we've already seen how the market has tolerated it, and I don't necessarily think it's really going to exacerbate much further than it has already. So as a result, I think it's more likely that Fed tightening will begin the process, which unfortunately may not be until next year. So you may have to get used to a life below volatility. Short Aussie below 93. I'm not doing it. I think 92 is a better level to short, but you're welcome to. If you're interested, you can just go to our website, bkforex.com, and find all the information that we offer. And I'll text you a link. Okay, any other questions? All right, so if there's no additional questions, I hope you found some useful information today. I'd like to thank all of you for joining me today, and I want to wish you a great trading day.